and I'm going to be at 7%, and you're next door at 3%, I just can't compete because my rents have to be significantly higher than yours. So we see the opportunities coming. It's just not there today. So we're putting most of it in single family. Right now, nationwide, we're short 7.2 million houses.
Hey there, and welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes, and today we talk with Dale Willis of Centric Companies and Centric Capital Partners a lot about the real estate market and what to look for when it comes to real estate investing and different aspects of economics and the economy and what's happening in even the political environment that is impacting investing in real estate. So if you are interested in learning about investing in real estate, making money with real estate, and some of the things you should be looking for if you're already in real estate, then this is a great episode for you to tune into. As always, like, subscribe, and share, and look forward to hearing your comments. Take care.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
Hey, and welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host here, Jeff Barnes. I'm today with Dale Willis out of Minneapolis. Dale, how are you today?
Doing great. Thanks for having me, Jeff.
Absolutely. Really excited to hear about you, learn about you, and everything you guys are doing in the real estate world, because, there's obviously a lot of things that are happening economically. There's a lot of things happening in the finance world. There's definitely a lot of things happening in the real estate world. So Dale, why don't you give everybody a quick background about yourself and how you got to where you are right now?
Yeah, I've been self-employed more than I've been employed since a young age. And I've been involved in banking. I used to do mortgage banking, construction development lending, worked for a company for a period of time where we created a new city from scratch. That was a ton of fun. You got to create your own sewer system, water system, the street layout, or golf course. That was a lot of fun. And really the company we have now was started out of the 2008 crash. And we started working with banks. There was a lot of bank-owned assets that they needed to figure out what to do with. And so we were working with them to create solutions to exit those. And that just evolved. And as those opportunities started to dry up, because the banks were working through those, we then started focusing on new developments, new construction, housing, value-add opportunities with apartments, office buildings, and those kinds of things. And today we're pivoting again as the market's a little bit different than it was just a couple of years ago.
Yeah, no kidding. So it's really interesting. I started my entrepreneurial endeavor while I was still in the Navy, learning about real estate investing. And that was the first thing I tried to do. And I found out that you actually have to be good at raising money generally. And I was terrible at that. But we managed to raise $5 million. And our first project that for some reason we thought would be a really good idea, my partner and I, we raised $5 million to do a new development. What do you call them? A subdivision, right?
Yeah.
And it required sewer and plumbing and bringing the electrical in. And it was also in the state of Washington here in a very, very EPA heavily protected area because of the salmon, the rivers, the streams, and all that sort of stuff, right up next to a mountain. And for some reason, we thought this would be a really good way to get started in the real estate construction and development world. Needless to say, it did not go to plan, and we ended up not really making things work out properly. So I never went down that path, but that was right after the financial crisis as well. So really curious, how did you get into building your own city, essentially?
That particular one happened to be in Utah.
Okay.
And I didn't actually build it, design it. I worked for the organization that did. Okay. And Utah's a unique market in that they've got mountain ranges that really restrict development. And so it's a lot of it in the central part is they have to go north and south. And there just wasn't a lot of opportunity, but there was some areas, these two areas that there just wasn't any housing. And so from a matter of just a practical standpoint, it was okay to make this work. You've got to create a city. The interesting thing is a lot of things were done out of necessity, meaning, there's no sewer capacity, so we got to create our own sewer plant. There is no water capacity, so we got to create our own water company. And so the original intent was really to develop land, sell lots, sell off to acre stores, grocery stores, apartments, all of that. But what ended up happening is one of the things that made the most money was years later selling the water and the sewer company back to the city. Because it's not easy.
Yeah.
Some of the things that you talked about, you've got the EPA is involved. You're next to a mountain. All of those things you talked about when you guys tried your first development. You can't just have a sewer plant and discharge the sewage out into the lake or into the river. And so there's a lot of EPA requirements, discharge permits. So it was a lot of fun and really educational.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
I don't doubt that at all. Yeah. And Utah's one of those absolutely beautiful states. But like you said, if you're in a certain area, it's very difficult. I lived in a town going way back when I was in middle school, a town of 92 people. All right. And we didn't have much as far as infrastructure went, right? One gas station that was also the general store, that was also the laundromat kind of thing. So I look at that and I think about what you just described to me. Reminds me of the video game Sim City, right? Going way back into the 90s. And this whole game was like, hey, you have to build an entire city. What are all the things you have to have? And yeah, all those little pieces and parts become really, really important if you're trying to get infrastructure for people to live there, right? And then you have to think about, okay, I'm assuming you guys went through all this. Why does the government even want that? Why do we even care? Well, there's probably resources and we need people to work there. And we need, whether it's mining or land development or timber, where I live out here in Washington, we need people to be able to, cut down the logs. Well, if they're going to do that, they got to live somewhere, right? When I was in the insurance world, we were actually insuring these tent cities, essentially. Now, when I say tent city, a lot of people think homeless encampments. That's not what I referred to at all. We're talking about North Dakota, where it was oil and gas. And really, really rich oil and gas deposits, but absolutely no infrastructure for people to live. So they had to go out there and build the entire infrastructure. And it started out with, okay, people don't have anywhere to live. They're going to live at the campground and go tent and hang out there, to all of a sudden having Connex boxes, to eventually building out the full infrastructure. So that's just really interesting. And I'd imagine very capital intensive as well. Yeah.
Yeah, it really is. It's interesting you bring up North Dakota, because we looked at that market when it was on fire, back in, that would have been 2012, 13-ish. And, being in Minnesota, a lot of people were going up there because the market was tough nationwide. So people were looking for work. So a lot of people went up there. And as I said, there was a lot of tent cities, and we were being encouraged and enticed by the local governments to go up there and build. And I looked at it and said, this is super exciting, but where are we going to get the labor to build everything? Our cost to build is going to be twice what it is anywhere else. And then the other problem was at that time, oil had to be over $90 a barrel to make those wells make sense. And at that time, oil is probably 140.
Yep.
But if it goes under 90, you got to put all that money in for that infrastructure. You put all those streets in, and that takes time. And then once you're ready to build houses, what if oil drops down to 80? I've got all this infrastructure. We're not right all the time, but that was one of the times that I was like, I'm not sure I feel good about this investment.
And that's something that's just so hard for people to understand who are maybe new to any type of business, right? Is the experience and the track record and the history that you have. Like you said, that one little thing, when oil's $140, what happens with most people? They're exuberant. They're excited about it. They know that they think nothing bad could happen. Even if it goes down, they would have said, even if it goes down $40 a barrel, right? That's going to take forever for that to happen. We'll see that coming. Well, to your point, do you really want to invest and think about that and plan this? Because it's not even a 12-month thing. This is years in development, right? Yeah. And anything can happen. We actually had a development. That's why I'm really curious about this with what you're doing, and really interested in your history, is that we had a development out here in my town, Bonnie Lake, Washington area, called Cascadia. And I was looking at this, and it was a brand new, just hundreds and hundreds of, actually it was thousands of acres at the time, and no city anywhere nearby. And so the developers came and said, hey, we have this great idea. We're going to have this whole self-sustaining city and development outline network. We're going to build the whole thing from scratch. Just absolutely stunning views of the mountains and forests and everything. And they went bankrupt during 2008, 2009, because they had planned, and they said, well, everything's growing like crazy. The housing market's on fire. We're going to invest in this. They had literally put tens of millions of dollars into this thing. And, went out of business because they weren't planning for that. Now somebody else has taken over since then, become this amazing facility, entire subdivision. But yeah, that risk mitigation mindset is so important when it comes to the any business really, but definitely the business you're in, which is again very capital intensive and building things out. Now, I'm assuming that's not the only thing you're doing these days, right? You're not just focusing on building up new cities. So what is it you guys are working on these days?
Yeah, we're right now, because of the opportunities, we're doing very little in retail, office, or apartments. And that's really because of condition of the market.
Mm-hmm.
So most of our energy is currently focused on new housing. There is a huge need for apartments right now, but the metrics are skewed. There's a lot of people that bought apartments or built apartments 3, 4, 5, 6 years ago. And, they borrowed at a 3% interest rate, give or take. And
right.
They also performed these things at a low single digit cap rate. The problem with that is a lot of these guys now are facing balloon payments. They got 5, 6, 7, 8 year balloon payments on these things. Well, all of a sudden with my interest rates at 7%, this thing doesn't pencil. So we see some opportunities are going to be coming very soon in the multifamily. But currently the challenge is if I've got to go build a multifamily or I'm going to go do a value add opportunity, and I'm going to be at 7% and you're next door at 3%, I just can't compete because my rents have to be significantly higher than yours. So we see the opportunities coming. It's just not there today. So we're putting most of it in single family. Right now, nationwide, we're short 7.2 million houses.
Yeah.
And that's real. We're seeing it. Our home building entity, we build everything on spec, meaning everything we build has no buyer. And we don't release it for sale until we start framing the house. We've had one house get finished in the last 6 months. Meaning everything we start is sold before we finish the house. And that's pretty quick because right now we're building houses in about 105 days.
Wow.
And so there's a need. We see the need. We know there's a need. And so we're trying to fill that need. It's just not as much on the apartment side. But what will happen is as we start seeing these balloon payments come due, we'll see value add opportunities that we will definitely be jumping on when that happens. We'll also see people are going to start having to push rents. And as rents go up, the new construction deals all of a sudden pencil.
And it's such an interesting, Mario, like you said, 7.2 million essentially doors or houses short in this country. And we could talk about economics for a long time now, right? Like you think about, so I'm what you might consider the elder millennial, right? Born in the early 80s. And I detest that term millennial, but it is what it is. But you see a lot of these folks that have born, they're entering the workforce. They've been in the workforce for a few years now. They're born, even Gen Z now. It's like they can't afford housing like previous generations because of inflation, because of the cost of everything. I mean, geez, when COVID happened, all of a sudden the price of lumber went up. I can't even imagine I live in Washington State where lumber is plentiful. And we saw a 300% increase in the price of lumber and materials. And as a result, the housing just went, the new cost, our new construction skyrocketed, right?
Yeah.
And wages didn't change, right? Like wages have not kept up with the inflation that we've seen. And so these folks that are entering the workforce are having massive challenges getting the credit or getting the buying power that they need to buy these houses. Plus, because of advancements in health and wellness and the fact that we don't have as hard of labor jobs and we definitely don't have pensions anymore. People are staying in the workforce even longer. So, it's this really interesting time in economic history where we're seeing the first time ever where fewer people are becoming those first-time home buyers and more people are choosing to rent and stay as renters. And so to your point, it made sense when interest rates were really low to go out there and start building as many apartments as you can get. But the balloon payment thing, I've been wondering about that for a while. So talk to us a little bit more about that and how that kind of drives some of your guys' decision making. Then where do you find that kind of data?
Well, the balloon payments, I mean, it's out there. We're seeing the data. Also, our banking connections, people that we work with, are telling us, and we've borrowed enough on apartments that we know the game. We know what people are borrowing. And that's really a lot of how you know it is just having been a borrower and seeing the kind of terms they're offering. I mean, we've got 2 apartment complexes that I think our balloon comes due, we're 4 years out, 3 years out.
Mm-hmm.
But back to what you had said earlier, we don't forecast a deal based on what might become.
Right.
What are we dealing with now? Not, the market's hot, so let's take advantage of it, be bankrupt in a year possibly. And so we're looking at, where is that market going? Interesting note, my dad, he has an IRA, and he said, hey, can you look at this? So I looked at it, I looked at the fees he was paying and as a return, and like, Dad, the last 3 years, our average inflation is 5.21%. You're averaging about 3.5% return by the time you factor in fees and everything. You're losing money every month because you're going backwards, because inflation, you're not even keeping up with inflation. And so it's a tough predicament that we're in right now, is because to build more rentals, we're going to have to see rents go up, and wages, as you pointed out, aren't keeping up. And, Congress, under the current Congress, there's no way it passes, but there's a bill that's proposed that would make it illegal for corporations to own houses.
Right.
They think that's driving. It's like, well, what they miss is there's a lot of people that don't want to own.
Yep.
There's a whole new generation that says, well, I don't have to want to worry about when the furnace breaks. We own quite a few single family rentals. We own quite a few apartment rentals. Virtually 100% of the people live in the apartments. Their goal is to eventually own a house. Virtually everybody that lives in a house does not want to own a house, and that's why they're renting from us. It's a really strange dynamic that just, our political leaders just aren't quite in tune with.
Well, and it's driven by the fact, and at least this is my opinion, based on what I've learned, and you can tell me if I'm wrong or not, but everything has changed. I mean, geez, the last 50 years, right? Like we can go all the way back to Nixon and taking us off the gold standard and fiat currency. And okay, that made massive changes. Then you go from pensions, from defined benefit to defined contribution plans, right? The IRAs, the 401ks. And that's the book I wrote about over this shoulder, which was The Ultimate Guide to Self-Directed Investing and Retirement Planning. The whole reason I wrote that is because I saw what you just talked about. If I put all my money into this instrument, or whatever money I can put in there, and I can afford to put in there at the time, after, like they say, okay, 12% average return in the stock market, right? Then you start factoring in inflation and you start factoring in the fees. And you're like, no, I'm not anywhere close. And the time that I wrote that book, there was $13 trillion in retirement plans, right? And Social Security has been underfunded and all of this. So we have this massive shift away from people, and people are waking up to that. Like, wow, Social Security is not working for me. It's underfunded. I should be getting this amount of money. If I'd have taken my money and put it into a retirement plan, I'd be getting this, but I'm not. So why should I bother doing that? And that was a big driver for a lot of people. Like the defined benefit plans and Social Security was a big driver for people staying at a job for a long time. And then you get the internet, you get social media, you get the phones, you get all this stuff. All of a sudden we have this gig economy. Now I don't have to go have a job that I stay with for the rest of my life and hopefully have great benefits and all this stuff. Oh, and by the way, we also have this incredible thing called Zoom, right? Or telecommuting or whatever.
Yeah.
And then COVID happens. And now I don't even need to be located where my job is. I can be practically wherever. And so a lot of folks have done that. And you think about that and you bring that back to the housing. If I can work from practically anywhere, I can switch jobs on a regular basis. I can pretty much live anywhere in the world if I really wanted to. And I can go live where the cost of living is a lot cheaper. Well, why would I lock myself into a 5 to 7 year, I know it's a 30-year mortgage, but generally 5 to 7 years is when people buy and sell houses, right? That's the average cycle. And so why would I lock myself into that? And people are realizing that. So like, why I want a house because I really like the space and I like to have a front yard and a backyard and a community and all that and not feel cramped on like I'm living under and over people all the time. But I don't want to have all the responsibility of having that. And so I think your point about the short-term rentals, the long-term rentals, and the housing market makes a lot of sense. And of course, there's the other side of that coin, which is, we don't really want BlackRock buying everything because they can spend whatever they want on it. And so the people that do want to own, man, they're kind of priced out of the market. I'm curious about what your thoughts are on that.
Yeah, it's, BlackRock, there are certain markets. You go to the Phoenix market as an example, they own a lot of units there. But when you look at the market, nationwide, it's pretty minimal. The thing that really worries me, if it were to ever get traction, is most of these rental units, if you own 1 or 2 or 3 rental units as an individual, it's likely in an LLC.
Okay.
And a lot of these initiatives would say companies can't own rental units.
Oh, wow.
Which means if you're trying to build up just your own little retirement portfolio of I'm going to buy a house here and there and build it up and I own 10, 15 homes as an individual, a lot of these initiatives that are being proposed would make that illegal. You would not be able to do that. Minnesota is a perfect example. They just passed a law this last legislative session. Companies cannot own rentals in the state of Minnesota.
Really?
Now, they did a carve out because we were lobbying against it. I still don't like the bill as it was passed, but they did a carve out that it doesn't apply to me because I'm a developer. And so I could take a subdivision and build 100 homes and then I could sell them to you and that would be okay. But you couldn't come in and ask somebody to build the 100 homes to turn into rentals in the state of Minnesota.
That's so, and the thing that really drives me nuts is a lot of that is probably optics, right? Like, let's be honest. Most people, they hear, yeah, big bad corporations shouldn't be able to own an entire city. And they're like, yeah, I agree with that. But they don't realize that this broad brush approach to politics and rulemaking doesn't make any sense because it's the big companies that have the really expensive lawyers that know how to work around it, right? And they also, they're profit driven, of course, but there's a lot of benefits that come from this too. So my thought process, when you say no company can own it, it's like, okay, so my first thought was, well, can a trust then own a piece of property? And the average person doesn't know how to build a trust and have their own trust. Yeah. But guess what? The people who run the big companies know exactly what they're doing.
They do.
So there's a simple little loophole right there. And again, I haven't read the bill. I don't know anything about it. But my thought is they put these rules in place to make people feel good, like they're doing something wonderful. And in the end, it's just hurting everybody, right? Because if we took this down the path of, okay, what's the worst that could happen? Well, all of a sudden, these corporations then have to sell off every single property they own. And what's that going to do? Flood the market. And all of a sudden, everybody else who was hoping on retiring from the equity in their home, sorry, that's all gone. We're back down to a housing short or a housing surplus, I should say. There's all sorts of ramifications that come from stuff like that now. I know that people want to believe that the government has our best interest at heart, but that's a really naive viewpoint to take when it comes to stuff like this.
Yeah, I think what's really important, especially for the listeners of this podcast, you've got a lot of business people, entrepreneurs, investors, is there's opportunities. There's always great opportunities, and in 2006, 7, 8, oil prices were so high that people that wanted to get rid of their commute. So the opportunities were get closer into the cities. 2009, 10, 11, 12, 13, there was great opportunities with distressed assets. Today the opportunity is in for sale housing that's a tier or two out. We're seeing people that want to own a home. There's still a lot of people who want to own a home. There's also people that don't want to own a home. But to your point, there's a lot of people now that I can work through Zoom. I can telecommute. And so they're saying, well, I'm going to move out just a little further. It's a little more affordable. And so my payment's a little bit less because I don't have to worry about what gas prices were. Whereas in 2006, 7, 8, gas prices were going up at a rapid pace. And that was a big deal. People didn't want the commute.
Yep.
And so I think that's super important is government's going to do what the government's going to do. The economy's going to do what the economy's going to do. And in every situation, there are some really great opportunities to make a lot of money.
And you bring up a really important point, which is economists look at the entire economy, right? They don't look at the microcosm of the individual and say, well, how is Dale making his financial decisions right now? And they don't think about, and it's always a lagging indicator, right? When they finally realize this, like, oh, okay, yeah, they probably are making these decisions because of X, Y, Z that happened 3 or 4 years ago. Well, that doesn't help anybody who's an investor who's looking for opportunity, right? So when you start thinking about this, it's very difficult to pinpoint it, right? Like the whole move to suburbia was, we had the GI Bill, we had, really, really great incentives for people to buy the houses, and then the real estate industry comes to bear, and all of a sudden we have all this infrastructure outside of cities, and, why not move everybody into suburbia? And so that happened. It was a big push. And we've seen all sorts of different trends, into massive apartment buildings in downtown cities because of what you were just saying. And then there's, the issue of, okay, now there's the personal safety, or the guy who bought the downtown condo because he loved it in Chicago, for example, and all of a sudden gets married and wants to have kids. It's like, okay, maybe I shouldn't raise my kids right here. And, like all these little individual choices really make a difference in, the economics of investing in real estate, buying property, developing property, and things like that. So what are some of the things that you guys are looking at right now that makes us, like you already said, okay, we're really big in the single family. And I think the balloon payment issue is probably one that's right on the trajectory for you. And why is, like, give people an understanding of like what your thought process is there.
As far as what the opportunities are now?
Yeah. Why is this going to be an opportunity, right? Like, what is it about, the apartment building? Like you were saying, we're 7.2 million units short in this country. And you were saying, building an apartment building doesn't necessarily make sense right now because of interest rates, I'm assuming. But there are so many reasons why people would say, well, if we're 7.2 million short, do interest rates really matter? Why wouldn't I build? So what are some of the thought processes you guys are going through right now as you're looking at the future?
There's still an affordability factor.
Okay.
We have a rule in our house. Our kids can live with us as long as they're doing something meaningful and productive and advancing themselves. And so I've got a son who started up his own business who, he's at a stage in life, he could go out looking for his own house, his own apartment. But, affordability is such that why not stay home with us? And so he's building his business. He's getting it going. He's doing some amazing, fun stuff. And he's not moving out because of affordability. So it makes sense to stay. And so I think we're seeing a lot of that, households that are consolidating that normally would break up. And because that question's asked a lot. Where are these, if we're short 7.2 million houses, where are these people living?
Right.
And a lot of it is consolidated households is what's happening. And what's going to happen is eventually wages will increase to create affordability. We'll go into a recession, which is going to lower the price of some of the commodities and the labor, but something's going to change at some point because this isn't sustainable. As you pointed out, people just can't afford it. And as we have apartment complexes, we can't really raise rent right now. We would like to. We think they're worth more, but the market won't support it. But we're probably a year, 2 years out before we're going to start pushing rents again because there's still a need. We have 2 apartment complexes, example. We have no vacancies ever. It's how fast you move out and how fast can I turn this unit before the next person moves in. They're turning very quickly. And that's a sign of a shortage of housing. And so what will happen is in time, we'll reset. It's really important when we look at interest rates. Most of us are looking at the last 25 years where we just saw a continual decline of interest rates. It just kept going down. I mean, that actually started in the early 90s and they just slowly kept going down and down and down. And then we see these unheard of interest rates. If you go back to the late 60s, interest rates were really low. Early 70s, they start climbing. And the headlines were, let's wait to buy a house until interest rates go down. Well, guess what? That didn't happen until 1993.
Yep.
So how many people sat on the sidelines missing wealth? Well, we know over that 30-year period, we didn't stop building houses. We didn't stop building apartment complexes. It's just what happened is the rents and the cost of housing just continued to decline to match it. So it's all about affordability. There's a funnel philosophy that, the top of the funnel's here and it just gets narrower and narrower. And that's true, the buying power. Most people that are buying a house or renting, they say, how much can I afford a month?
Right.
It's not, do I want a $400,000 house or $1 million house? It's how much can I afford a month? It's not, do I want this apartment with the clubhouse and the pool? It's how much can I afford? Well, if interest rates go up, you're going to afford less. And so if I build an apartment complex and you're next door renting at $2,000 and my interest rates are so high, I got to rent for $2,800. Well, that doesn't work today, but slowly your rents are going to start climbing when your balloon payment comes due and you got to refinance, or somebody buys it as distressed and repositions it. And so we will then see those rates start to go up where all of a sudden now that $2,800 works. And now we're going to build that apartment complex and we're going to put people in there at that $2,800 a month. And that's just, it's going to take time to work through this. We saw very similar, not the exact, but very similar late 70s and 80s. We saw a similar climate to what we're dealing with right now.
And That's awesome. Yeah. And like you said, it's a long-term game, right? It's a long-term
Yeah.
play. You don't think about, okay, what's going to happen in the next 12 months. You think, okay, 4, 5, 6, 10 years, right? And beyond. Now this has been a great, Dale. We could talk all day. There's so many other things I'd love to ask you about and go into, but in the interest of time, I'd like people to learn a little bit more about, your company and where can they find out more information about you?
I'm on LinkedIn under Dale Wills. I'm pretty active on LinkedIn. Love the community that's there. Also, we have centracapitalpartners.com. That's our investment arm where we allow people to co-invest with us on whatever deals we're doing at the time. Right now, we're focusing on for sale housing. So it's centracapitalpartners.com that they can learn about investments. And then we also have Centra Homes and centracompanies.com. So we're all over the place. We love making connections and helping people build wealth with us.
Beautiful. Love it. We'll make sure we get all of those links, everything into the show notes. So if you're watching this and you're driving or you're listening to this, make sure you go check out the show notes so you can find out exactly where to go, learn more about Dale and Centra Companies and Central Capital Partners. Dale, it's been an incredible interview. I wish we could spend a lot more time talking about all the ins and outs of real estate investing in a number of different ways, as well as development and multifamily and all that. But, thank you so much for being here. I really appreciate your time and, looking forward to working with you and talking with you again in the future.
Jeff, thanks for having me. It was a lot of fun.
Absolutely. And if you are tuning in and this is your first episode of Angels, Exits, and Acquisitions, this is the kind of great information that you get a chance to listen to and hear and watch and learn more about all the different aspects of angel investing, acquisitions, real estate investing, private equity, exits of any type. So make sure you subscribe, like, and share, and we'll see you on the next one. Take care.